Abhi, will the governor today say cheers at the credit policy, or he's going to say, forget cheers, I mean, don't talk about wine, let's talk about potato onions and what's happening in the thali?
Good question. I don't think there is any reason for him to, celebrate or raise his glass and say cheers. I think although potato, onions, and tomatoes tends to be transitory, there is a bigger problem with food inflation globally, and some of it is being driven by factors specific to India. For instance, the overeating in rice prices. So, to cut a long story short, since we don't have much time, I think he'll have to stay on hold, talk tough. Perhaps I'm not too sure because liquidity has in the market has picked up quite a bit. He might want to do something on the amount of durable liquidity in the system, but that's really sort of a tail chance. But I think it'll be a hawkish hold, to use market parlance.
Abhi, I think you made this very interesting point that Reserve Bank of India will have to get the guns ready to fight inflation. The guns were, parked back in the barrack. Now the guns have to be bought out. Do you think Reserve Bank of India this time will be forced to sound hawkish?
No, I think they have been, Nikhil, to be fair, they've been sounding hawkish all through, although they've sort of kept rates on hold or put their guns in the barracks. They have stayed pretty much hawkish in the last policy. Quite surprisingly, they stressed the fact that they were kind of focused on the 4% medium-term target. So I think they'll sound a little more hawkish this time. Having said that, I think they will also emphasize the fact that one of the things that the market is a little scared about, and if you're looking at 10-year bond deals, they've shot up quite a bit. Now, what I think he will say is, although there is indeed a problem, there's a likely problem in July, August, September with headline inflation, there are major transitory elements like tomato prices, potato prices, which are playing into it, and that supply measures in a number of categories are in place, etc. So, I mean, I think he's going to sound hawkish, but he's also going to say that there are things beyond the RBI's remit which are being sort of rolled out, and I refer to yesterday's announcement on wheat and rice, and so the transitoriness, the supply side measures, but a hawkish stance. And don't forget, I mean, I think the bigger fear, Nikunj, today is what happens to US CPI inflation that comes out today, because that's going to really roil the markets. And the rupee is under pressure, so he'll have to sort of walk a very fine line to ensure that you suddenly don't see a lot of capital outflows if the US inflation surprises a little bit on the upside, because the markets are so skittish that anything which is remotely surprising is leading to huge reversal in flows. And let me emphasize the fact that the RBI is now almost explicitly looking at a stable rupee as a kind of a target or something desirable, which it's communicating to the market. So, that being said, so he'll have to manage a whole bunch of things.
Namaskar.
Well, done with the policy along expected lines. The MPC has kept the repo rates unchanged at 6.5%, retained its stance at withdrawal of accommodation, and the stance with a 5:1 majority. Also decided to be watchful given the economic situation. They've retained the rate but prepared to act if inflation warrants it so, and that they're monitoring the situation pretty closely. They remain resolute to bring inflation to 4%. Before I take it across to our speakers and get in a reaction from them, it's important to mark the equity market reaction, because up until pre-policy, what looked like a very quiet, sedate kind of session, we've fallen almost 1% from the top of the day on the Nifty Bank, and the Nifty also is now significantly below that 19,600 print. They go just about defending that 19,500 mark, and that's a fall of over 100 points that you're seeing. Asian Paints, Hindalco, Tata Motors, HDFC Life, ITC, ICICI Bank, Kotak Bank, L&T. The selling pretty much is across the board. Abhik Barwa joins in on the show right now. We also have with us Ashutosh Khajuria joining in on the show. Gentlemen, Abhik, welcome back to you. Mr. Khajuria, good morning. Abhik, was the stance really that hawkish for the market to fall the way it is? Because it's pretty much along expected lines.
Yes, one of the things that you didn't, I mean, you described the key elements of the policy, but
Sure.
one thing that you didn't sort of refer to was the was this incremental CRR. It might be temporary; it could just be viewed as a technical measure. But if you see it as an additional monetary policy signal and a sort of a tightening signal at that, indicating that the RBI is not comfortable with current levels of liquidity, whatever the drivers may be, then I think that is the bit which I was not priced in by the market. So I think that bit, whether you see it as a signal, whether you see the impact on the cost of funds for banks, etc., is a surprise. So I would tend to see that the broad message of the policy as very much in line with expectations, very sort of justifiably highlighting inflation risks, revising the Q2 numbers and so forth. But I think this additional bit came as a bit of a surprise, and the market is seeing this as a further proof of the RBI's, hawkishness. You could call it hawkishness, or its commitment to bring, inflation down to the 4% level in the medium term. And if you just look at the numbers that they have put down in terms of the forecast, it's sort of way off the 4% mark, which also suggests that it'll be rates will be on hold or possibly even higher if conditions warrant for longer. So I would read the markets somewhat unexpected reaction as a response to these developments.
Across to the banker on board, Mr. Khajuria as well. Is that really a big impediment coming in? Because credit growth was expected to be quite strong, 12 to 14%. Now with this incremental CRR coming in, of course, the governor has talked about how they'll relook at it ahead of the festive season on September 8th. But this 10% additional ICRR takes away any more liquidity that you were getting on account of the 2,000 rupee note. A big dampener, Mr. Khajuria?
As Mr. Barua rightly said, it was not expected. This type of tool has been used by RBI in the past, but that's too distant in the past. So incremental CRR certainly is going to bring in cost to the banks. Cost of funds will go up. I think the deposit growth that is coming out, for the group as a whole, all scheduled commercial banks, is slightly optically, impacted by the merger of HDFC Bank with HDFC Limited. So whatever deposits they had would now be moving to the banking system from non-banking system also. Same is the case about the credit growth as such. I think liquidity, if you just look at the LAF absorption numbers for the month of June, Governor said that it was 1.7 trillion, which moved to 1.8 trillion in July. So it doesn't seem to be, suddenly has, moved quite high. Because of that, probably it was not something which at least the banking sector was expecting. So it's going to, certainly lead to higher costs. So it's indirectly could be partially equivalent of the rate hike or so as such, because the cost would be then passed on to the borrowers in one way or the other. So, though it's temporary and the announcement says that on 8th September or earlier, it will be reviewed, but it certainly is going to take away a lot of liquidity from the system on one hand and add to the cost of the banking system.
Absolutely. In fact, I must, before we take it across to Mr. Ajay Srivastav and Ashwini Tiwari, highlight what the Nifty Bank is up to, because that's fallen a good almost 1.5%, and a lot of these banking stocks are really cracking hard. That's the kind of fall that we're seeing in the banking names. But Mr. Tiwari, there's, ICRR on one hand, but there's also a consumer-specific move. The RBI now plans to put in place a new framework for resetting EMIs or floating rate rate loans in case of the rising and falling interest rates and the kind of volatility that one is currently seeing. For consumer protection, that is. For many banks currently, the norms are pretty non-transparent. How are you reading into both these moves? A, on EMIs, and other one, of course, on ICRR.
So ICRR, as Mr. Khajuria pointed out, was not expected. However, I would say that the RBI has chosen to be safe rather than sorry. The inflation was volatile. It was coming down for the previous several quarters, but this quarter, because of the vegetable prices, it was slightly volatile, and therefore the projection also has gone up by RBI. So they have just played a little safe. To how much difference will it make to banks' cost and therefore pass on to the customers is still to be evaluated. If it stays only for the limited period which has been indicated for now, then it may not make a material difference. However, as we know, last 3-4 quarters, starting from I think September of last year, we have seen the credit growth outpacing the deposit growth significantly, not only percentage-wise, but also overall absolute basis. So which means the demand for credit has gone up significantly and the deposit growth has fallen behind. And that's a result. The rates in deposits also have been moving up in response to that demand, and also the fact that the cost itself have been going up. So that's on one side. So I'm not sure how much impact this is going to make immediately, but whatever benefits we could have gotten from, let's say, reduction of some rates due to the 2,000 rupee notes and other liquidity measures, those probably are neutralized. So that's one side. On the other side, the EMI case actually
connection. We'll try and patch that line again. But in the meantime, let me get the opinion from Ajay Srivastav as well. He's joining us to talk to us about how the market should read into all of this. Ajay, the overall sense seems to be a bit more hawkish in terms of the liquidity which has been sucked out of the system. The fact that the people who are penciling hope that there might be a rate cut at the start of next year, that now seems to have been pushed down the cart. Do you think this reaction that we are seeing on the banking stocks today specifically is a bit of a knee-jerk reaction?
I think it's not a knee-jerk reaction. It's a correct reaction because the market was going into the policy hoping that the rate will be low, kept same and ignoring the inflation headline. They just thought that tomato is not good enough to be considered as an issue is the RBI policy or for the equity market investors. Strange, but that was the logic of the equity market that, tomato inflation, onion inflation, how does it matter to us? RBI should ignore it. RBI cannot ignore it, did not ignore it. But what came out today was very clear. RBI was, I'm sorry to use the word, little scared. They went for the move to say we're going to put 10%, but what they did next was amazing. September 8th will be a review date. They didn't need to do that. That is what brings up the inflation expectation. That RBI is actually saying, I want to be tough, but is absolutely tough to say, I will review this 10% on September 8th. I should have been left open-ended and saying, we will keep the inflation in mind and we'll do it. And if you're a saver, mind you, we talk about only equity market, but equity markets get funded by saver. If you're a saver, you're on your own now because your real interest rate after a long time became positive by 1%. Now with inflation rate going up by another 0.7%, you're back to the play where you have at most break even and you might even go under. So I think market has to contend with the reality. We have an inflation problem. The RBI is behind the curve on inflation problem. Today, it definitely looked circumspect as to what to do with inflation. They have hiked it. They have said, we're not going to be anywhere close to our targeted 4% in the next 12 months. There's not even a plan to be at 4%. And remember, oil is at 85, which is the base number which RBI uses for carrying their forecast for inflation. So net, I think correct reaction equity market is a good correction. It's the right correction reflecting the economic fundamental. But this is not good for the market because there is a scared RBI sitting there who's worried as to now what do I do with inflation when I've created a paradigm of complete liquidity overhang and somnolent people expecting interest rate cuts. So the expectation is what is being adjusted today, if I may say so, not necessarily just the steps.
Ajay, it was a bit balanced in the sense, yes, what you're saying is also right, that the inflation of tomato, onions, etc. can't be ignored. But yes, they are going to review it on September 8th. And also the fact that they've increased the inflation target for the entire year, right? It now stands at 5.4% versus 5.1% earlier as well. For Q2, it has been substantially hiked as well. But he did also allude to the fact that the vegetable prices are expected to sharp very, very sharply as well. He said it might take a very short time and inflation might come off very sharply very soon as well. And Kharif crop, as per him, is going quite steady. So he's not too worried as far as the food inflation is concerned over medium term. Yes, short term, that might be a bit of a worry. I think we have Mr. Tiwari back with us. So just let me toss that question to him as well in terms of the ICRR. What does it do to the cost of funds? What will it do to loan growth? Because deposit growth has been, pretty much 10-12% range. But any impact it will have in terms of fueling the loan growth going forward?
Earlier, the loan growth has been outpacing the deposit growth for the last several quarters, starting from September of last year. And it is not only in percentage terms, but also in absolute levels, which clearly means there is a good demand for credit growth. And at the same time, deposits aren't keeping pace. So in that sense, this measure is going to not help in that sense. But as I explained, this is a temporary measure. And hopefully in September, when the governor reviews, they may take it back, because it's more of a signal rather than actually the overall impact of this on the cost, etc. So that's as far as this goes. For us, it's a temporary measure, not too much impact, more of a signaling area.
Just want to mark the market once again, because it's quite a serious move that you're seeing, and the fall hasn't quite stalled. We're now down almost 150 points actually. Little bit of a recovery, but let's see whether it sustains or not. We did almost get on the brink of even breaching 19,500. And remember, yesterday we closed above the 19,600 mark. So it's a 270 point fall, no less, that you're seeing for the Nifty Bank. Whether this decline gets bought into, that we will find out in the due course of the session. Of course, the fall is led by banks, oil and gas and FMCG names. They are the ones which are really taking it hard. Even the broader end of the market has cooled off significantly. Even the mid-cap index is now lying flat, which is pretty much still trotting around its life highs. But Abhi, just wanted to get your sense in on where do you think the next course of action is going to be. The governor, like Anisha was just highlighting, is pretty confident that the inflation is a short-term phenomena, and once the weather disturbances, monsoons are all out of the way, the prices should see a significant cool off. But in that light, assuming that happens on course, what do you think the future rate trajectory is going to be from the RBI?
Look, I kind of disagree with your interpretation of what the governor said. The governor said that, look, I mean, food and other things might be, vegetables, tomatoes, potatoes might be transitory, but there are, El Nino related risks, which, global food markets are tight, etc. So we might have a problem that extends beyond this sort of transitoriness of vegetable prices. At this moment, we are assuming that the monsoons are normal. We are assuming that El Nino doesn't have a major impact, and hence this is our forecast, and this is what we. So but he also said that if things turn out to be, because you must remember that food inflation has a major impact on inflation expectations, and that's the bit that bothers central banks. So if we see, well, if it's all peaches and cream and tomatoes and onions, prices come down and everything goes back to the past level, although the trajectory would be a little higher, then we are fine. But if we have additional problems on the food side, the RBI might be forced to act. So, in the best case, no further action for the rest of the year. This liquidity action turns out to be a purely sort of technical transitory move. Rolled back in September, but given the 4% target and the continued emphasis on that, rates might not be cut before 4%. A lot of other factors are at play. I'm not going into that. The Fed, US CPI, etc. But if things turn out to be not as rosy as I'm sort of in the baseline scenario is painting, and you have a problem with cereal prices, pulses prices, oil prices. I'm talking about cooking oil. If they remain elevated, then we have a different story. And let me just be a little bold and say maybe a rate hike is not off the table, going forward.
Rate hike is not off the table. Is that something you as well, Mr. Khajuria, agree with? That there was a bit of a mispricing, as Ajay was saying, with respect to inflation expectation in the market. And now Abik is suggesting that there could be a mispricing if you're thinking that there's going to be no rate hike.
I think with this measure of incremental CRR, I think CRR, as everybody knows, it's the crudest tool to immediately have an impact, because your rate hike and all takes its own time for transmission, monetary transmission. Earlier system, MCLR and all used to take a longer time, and now, most of this EBR linked loans are linked to repo and all. So they get repriced much faster. But CRR is immediate. From day after tomorrow, the impact would be there on the banking system, 12th of August. So I think what it suggests is that rate hike has been put on back burner for some time, because both won't be going hand in hand. Your ICRR and immediately followed by rate hike in maybe October sometimes or so. Probably this is a substitute of that, but I mean that all depends on what type of data comes out. So we need to see what type of output is then expected of Kharif and all. Yeah, there has been spatial distribution related challenges on account of the weather inclemencies and all that, starting with Biparjoy and all. But fact remains that the flow of, or rather inflow of vegetables and all would start from middle of September. And then if we have adequate supplies of these vegetables who are right now short in supply, probably the challenge would be to that extent, taken care of. So probably this 8th September could be quite indicative of the expectation that the non-core items, particularly the food items, and within that vegetables, could be, their prices could be coming to normal by that time.
Okay, so that's the take coming in. A quick look at the market. If there is any sort of stabilization, at least the mid-cap index is again inching higher. And let's see whether the banks have stabilized or not, because the PSU banking space, that was getting the maximum hit. Let's take out the intraday chart if we can of the banking index, specifically the Nifty Bank and the PSU banking space. So yes, there's a bit of a semblance of recovery. Not that there's a V-shaped move or anything, but at least from the bottom, we have tried and made a bit of a comeback as well. Mr. Tiwari, the other thing, of course, that Aisha also was pointing out from the consumer point of view, there's that rebalancing that will happen. And that's been a complaint of a lot of us consumers as well, that when the rates go higher, the rates get adjusted for your loans, etc. But when it comes down, it doesn't get passed on in that manner. Do you think it's a double whammy of sorts coming in for the banks, that they will have to pass on the declines and it will have a sudden impact on their yields and spreads?
No, so the decline in rates is not happening as of at the moment. In fact, whatever the discussion has been happening so far is whether the cost of funds to the banks goes up. You have to remember that the RBI has, over a period of time, stipulated the retail rates to be linked to an external benchmark. And for most of the banks, it is the repo rate. So if the repo rate goes up or down, the rates automatically get repriced. There's no question of not reducing when they are coming down. However, as far as the corporate loans are concerned, that's a little bit of a challenge, because most of them are linked to MCLR and whichever resets of 2, 3 months, 6 months, sometimes a year as well. So they get repriced with some lag. However, if the rates are in the favor of the corporate, they typically come back to the banks and try to renegotiate the change, etc., or they simply pay off and go on to the another bank. So in that sense, for retail, by linking you to the external benchmark like repo, I think this has been taken care of. What the RBI, in terms of the EMI changes, etc., wants a transparent framework, perhaps, is the fact that when the rates were going up, most of the banks, they increased the tenor. And in some cases, the tenor went up beyond 30 years, 35 years, up to 75, 76, like that. And that is something which the RBI was slightly uncomfortable with. They said that in case, it cannot just go.
We seem to be having a bit of an audio issue. Call it the weather effect, not just for our audio troubles, but yeah, for the inflation fighting as well. And that continues at the central bank too. And of course, the bigger dampener has been the ICRR of 10% on increase in NDTL between May 19th and July 28th that the governor spoke about. But gentlemen, all of you, thank you so much for all taking time out and analyzing the RBI policy outcome for us. We leave it still